Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, December 15th, not December 14th. 5:13 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Making a couple of changes here on the fly. And I think you can probably guess why. State of the market, dying bear market rally. You could say it's on life support. You could say it barely has a pulse, but decidedly negative action today after FOMC yesterday. So let's go to here over here in the trend gauge. Neutral on leadership, arrow flip to red. Short term, we're neutral, arrow flip to red. We get two closes below tomorrow. This will go to bearish. Medium, still on red, arrow yellow. First index to break below the 50-day moving average today was the NASDAQ 100. We'll take a look at that when we look at the charts. Long-term yellow, sub-arrow red. Certainly not a good trend, what happened today. Post-FOMC action clearly negative. Take a look at the numbers. G6 down 1.57%. S&P 500 down 2.5%, NASDAQ 100 down 3.4%, Dow down 2.25, mid caps down 2.27, Russell 2000 small caps down 2.5, 60/40 global diversified stock and bond down 1.6. In-house, we were down just barely under 1%. A lot of stops taken out today in our portfolio. We'll discuss that when we go through the tail of the tape. But bottom line is, after having overnight to decide what Jerome Powell had to say, the market decided that actually the G6 was not down 1.57, it was down 3.10. I had a feeling something was wrong there. The market decided that higher for longer as far as interest rates go is not in the best interest of owning stocks. And we've been talking a little bit in these videos about how we appear to be transitioning from not as much concern about inflation and more concern about the recession and how that's going to impact corporate earnings and how those earnings are going to impact the multiple on S&P and how the combination of those two is going to impact where the S&P is trading at. So this little table I created has the 2023 projected earnings for the S&P 500 companies. Last time I read, it was around $225, and it's not going higher. Give that an 18 multiple, and you have where we opened today, which was, and where we closed the prior day, between 39.60 and 40.50. We're now closer to 215 in earnings, or 225 with a 17 multiple. See, there's a lot of moving parts in here, and you can't just focus on the S&P 500 because capital flows to where it's treated best. So you really have to uh, go through these gyrations all across the globe to see what other countries, what emerging markets are doing, what bonds are doing, and decide where capital is going to be allocated. But based on the initial reaction today, uh, my my expectation now is that this is the beginning of the fourth leg down. It won't go straight down. We'll bounce around. We'll hit different resistance areas, but not a good sign here. So you see the S&P 500. Let's bring up a 5-minute chart today, and here's your gap down and just trending lower all morning till the afternoon. We decided to go sideways a little bit around 38.90, and then a little rally late afternoon. Where did it stop? Right at 39.04, where it broke down here. Remember, we've got a key fib here around 39.07. So we got down there. I mean, it's classic support turning into resistance. Down to 39.03, bounce, undercut it, rally into 39.03, rally just above there a couple times, fade into the close at 38.96. If you look at the 60-minute chart, this breaks this 39.50 area, also breaks the 3900 area. So the rally today, the afternoon rallies were right above 3,900 and failed. You can see we tested 3,900 here. It flipped from resistance here. We got above it, came back at support. It's supported, it's supported, it's broken, rally back up intraday. Uh, the bulls want to see at least an attempt to get back up into 3,900 into the 3,950 area. But in my opinion, right now, that is just an opportunity to sell some things that you're holding on to, and that's the tack that we take when we're not only below the 200-day moving average, but then break back below the 21-day moving average. I've got 150-day moving average on here, which is just about in line with the 100-day, and we broke below that also, just barely above the 50-day moving average. So the next level down is that 50-day at 38.62. Today's low is 38.79. We're down a little bit after hours also. But I don't know that we've taken out the lows, the intraday lows. Let's go to the SPY and see. Intraday low in the SPY today, 387.89. We're at 389 right now, so we're still above that. But today's lows, the next support area down, since that's where we bounced. Here's the Nasdaq 100. We broke the 50-day moving average today, after closing basically right on the 21-day yesterday. Dow Jones Industrial Average broke a key level today, the 21-day exponential moving average, after bouncing off of it all of the last week and a half. You know, the more you pound on a support area, the weaker it gets. Finally given way today. 34,000 decisively broken. We bounced at 33,000 today on the Dow Jones Industrial Average. Here's the mid cap index, broke the 200, sitting right above the 50. This is the first move below the 200 since we got back above it in the beginning of November. Decided change of character there also. Small caps, terrible, broke the 50-day moving average. We put a short on today on that break of the 50-day moving average on small caps. Also, all of the stochastics for the five major indexes and the G6 have all turned lower now. Let's take a look at a couple other. The even weighted index, here's RSP, broke below the 200-day moving average. For a while, there was an argument that, hey, look at the even weighted RSP. Don't look at the S&P 500. Still down 2.2% today versus 2.5 for its market cap weighted brethren, brother index, sister index, whatever you want to call it. But um, breaking the 200 today, so that's changing character. Also, equal weighted Nasdaq 100 down 3.12 versus 3.36 for the even weighted, back below the 200-day moving average. The dollar higher. So this 28 low, significant move off there, but right into the 200-day moving average. Now, the 200-day moving average is not declining, so the dollar can continue to trickle up without getting above the 200-day moving average. This is one of the things to consider when you're seeing a moving average and it's acting as resistance. But after it's supporting the dollar for the prior 2 weeks, broke below it today, bounced that 28 area. Let's go to the VIX. VIX right on the 21-day moving average today, bounced. Long way to go higher, and with the VIX a long way to go higher, that means the market can go quite a bit lower. How did gold do on a day like today? Gold was down 1.6%. Again, can't hold this 200-day moving average, so this is a failed breakout after 2 days above it, sitting right on the 21. Gold stocks, similar action, back below the 200. In fact, a close below the 21. How about Hi-Ho Silver, which had been leading, down 3.4%? Still really just a normal reaction there after this intense uptrend that it saw over the last couple of weeks. Bonds, TLT, not a lot of movement here on bonds, so there really was kind of a tight range on interest rates also. Uh, Gap down, a little bit of a rally into yesterday's lows, sell off, a little bit of move up into the close. Remember, these close at 3 o'clock. TYX, the 30-year, kind of the same formation. Uh, This is a 150-day moving average, and that's where it's sitting right now, also known as the Weinstein line. But note, after being oversold, tried to get back above and now rolling back over again, which is interesting considering higher for longer is what the Fed has been talking about. The bonds not really impressed at the current time. So those are all the key indexes. I didn't discuss what we do here at Revere. Let me go through it very quickly. We're an active shop. Active management, our uh, number one priority is protecting client assets. Nobody wants to see a 20, 25, 30, 35% loss uh, as you're approaching retirement. Uh, after planning and having your nest egg saving, it can be just taken away from you in a matter of 6 months, a year, 18 months sometimes. This is a long market that we're in now. A lot of people are saying we're going to challenge these lows from October, where we're down 27.5%. Right now, we're back to being down about 18% on the S&P 500. So uh, discretion, the better part of valor. We key on the indexes and where they are relative to their moving average, but we are extremely defensive when we're below this 200-day moving average because all those stats I just showed, they all take place below there. We've been chopped up a couple times over the last couple of months, but have gotten nowhere near, in fact, not even half at the worst of where we were down the worst year to date. Um, and again, below the 200-day moving average and below the 21, that's a recipe for getting extremely defensive. And we'll go through the sales and our adjusted allocations today. And if you're interested in an approach like this, give us a shout. Email Donna@RevereAsset.com, phone 855 Real Wealth. If you didn't sell and then saw this rally off the lows and say, see, I didn't need to sell, how are you going to feel if we make lower lows here? Especially considering uh, this chart here. This is what all the fundamentalists, we're chartists primarily. Um, and then in individual stocks, we require strong fundamentals, but uh, fundamentalists require a multiple that's reasonable for the type of market that we're in, and then cross-reference that to what the earnings are going to be, and that's their target for where they think the S&P 500 should be trading. And if it's significantly lower than where it is, they're taking every opportunity to get into defensive stocks and out of anything that's higher beta. So again, the warning's there. The reaction after FOMC is decidedly negative. We'll be going back through all the FOMC decisions and the reaction afterwards. Uh, very often we see bounces. We'll keep an eye out if we're going to have a bounce. But again, as of right now, our feeling is that bounces should be sold. So let's get to the tail of the tape. Near dead bear market rally, as I said. Um, all the technicals have flipped to red. Bull case, this will go. We closed the week below the 21, where we're totally off of the bull case. News today: retail sales weak. Now, normally that would be good, but now, as I said, the mindset seems to have shifted to how bad is the recession going to be now that inflation appears to be at least somewhat under control with the moves that the Fed has made, and Jerome Powell very clearly saying we're not letting up. So that indicates that inflation should continue to come down. Philly Fed and Empire State Manufacturing Index still contracting. That's indicating recessionary. Our day count down from 1 plus to 2 plus. And we were read that day of CPI, but we finished. It was a big negative reversal. So I went back and forth. It's hard to call it an up day. So arguably, you could say we're 3 days down. Let's take a look at this. Here's the attempt at new highs and the big negative reversal. We finished positive, but it wasn't a good day for the bulls. So arguably, we're 3 days down now. And normally, after 3 days, you halt a little bit. If we see additional strong selling tomorrow, That's a big cause for concern because it reminds me of this area or this area or this area or this area. Uh, we uh, need to be vigilant right now with the break back below the 21 and under the declining 200-day moving average. Uh, Tesla, we know why now it has been weak all week because Elon was selling shares again. Netflix took a big hit today because a report came out that they are letting their advertise. Remember, the big end for Netflix, and one of the reasons why we bought it is because they had that new tier that was ad supported, uh, but not enough people signed up for it. So the ad numbers that they promised people were weaker than what they said they were going to. So they're allowing these companies to take their ads back or to reschedule them for next year. Bottom line is that Netflix dropped 8.6% today, and our stop was hit. Expectations neutral coming into today, very negative now with the break. Levels support broken on both the S&P and the Nasdaq 100. What was strong today? The dollar. Building stocks, particularly home builders, and oil producers, XOP. On the downside, gold, silver, and gold and silver stocks, 11 out of 11 sectors down. The SOX, very weak. Software, very weak too. Really tech across the board, which is typical of the type of market that we're in. We'll take a look at the focus names and what we still own after getting stopped of Netflix and Nvidia. We added the short on the Nasdaq. Sorry, on the small caps after the break of the 50-day moving average. We added more to our S&P 500 short after the break below the 21-day moving average. We sold Netflix, Nvidia, trimmed half of five. We also trimmed a third of our SPXL to get our beta down, not to a 0.33, but to a 0.12. So it's a significant drop in our exposure today with those stops getting hit and us getting more defensive relative to what the indexes are doing. Bottom line, post FOMC reaction is clearly negative, back to defensive posture. You can see we broke several support levels today. The 21, this 39.50, 39.60 area, the 100-day and the 150-day, and we're sitting here at 38.96. Next level down is the rising 50-day moving average in this 38.87 to 38.89, which we actually undercut and reclaimed today. So let's get to the focus list now, but really shouldn't be focusing on getting long at all. But let's take a look at why we got stopped today. First of all, NVIDIA, we bought it expecting to hold the 200-day moving average. After showing some serious relative strength, it broke it. Our stop was hit, taken out. Netflix, the big gap down, and pretty big selling volume, 47% above average. Uh, Money has clearly been flowing into this. I think that this changes the character today with a break of the 21. So we did some offensive selling last week, some defensive selling today on this. PI, we're sized to handle a move down to the 50-day moving average. Not a good day for PI today. Five, we sold half of it. uh, Generally because of the market weakness, broke below the ADMA. So the remaining part should hold the 21. We're sized down to 2% on that. We took 20% profits on half of our Mobileye. Wasn't a very big position, and it's still riding the ADMA higher. But in this market, this thing could be down significantly with the ATR. Right now, it's holding up well, but we booked half of it to lock in a +2R gain. TMDX, we're still holding our small 1% position on this. Alex is going to talk about this tomorrow on our podcast, making a special appearance. We can see it undercut but reclaimed the 21 today. Finally, FAS, we've got nice gains on this. We're just riding them and managing the position now, a move up into this declining 50-day moving average. Let's take a look at XLF. This is really what drives. We undercut but closed right on the 50-day moving average on this one today. So we'll be watching these two moving averages for when to lock our gains in on this. Financials today not quite as weak as the market, down 2% with the S&P down 2.5%. Now the typical suspects, Apple, uh, terrible break of 140. Not a good sign at all. Microsoft, this was holding up pretty well, but I mentioned how it failed at the 200-day moving average 2 days in a row. Still sitting on the 21, so still the best acting of the really big uh, FANG type stocks. Now to some sectors that are acting okay and actually surprisingly well. Remember, interest rates up. People can't sell their homes because of interest rates. So why are home builders continuing to show relative strength? Well, they did have this big gap up and reverse just like the market did, but we bounced at the 21 today. Here's the home builder ETF still holding the 21. There are not a lot of ETFs holding the 21. Here's ITB. This is a little bit stronger. It's more to the weighted to some of the bigger cap home builders, such as Toll, Lennar, and DHI. Here's Toll, finished positive on the day. Not a lot of stocks did. Here's DHI, finished positive today. Very nice bounce off the 21, up 3.5%. Relative strength at a new high. And Lennar, which got an upgrade yesterday, reported earnings, initially gapped down, but it bounced right at the 21 and ended up 4%. This is where the money's flowing right now. And look at the relative strength from all the way back here in September. The relative strength line has been trending higher, picking up strength recently. But the home builder is doing better than stocks like Home Depot. I went through this entire retail wholesale building products, and Home Depot is really the only one that's standing out. Uh, Relative strength at a new high for this today, recent new high anyway, and still holding the 21. But very clearly money flowing into that sector, probably the most healthy sector. The second most healthy sector was biotech. Let's see how they did today. Pulled back 1.8% on the big cap, sitting on the 21. XBI, the more speculative, broke below the 21, still in this long flat base here. Individual biotechs, a lot of them still holding up pretty well. So that's going to wrap it. As always, love to hear from you. Email is don@revereasset.com. The phone is 855 Real Wealth. That's 855 732 5932. You can also email my partner, Danny Stewart, about coming on board. That's dan@revereasset.com, and he can answer any questions you have on any financial matter, whether it's tax, estate planning, trusts. He's your guy. Uh, Give us a shout, especially now that it looks like we're starting a fourth leg down. It's time to get defensive again. So remember, it's not how much you make in the market, it's how much of that you can keep. And with that, I'll wrap up Thursday, December 15th. This is Don Vandenbord telling it like it is. Thanks for listening and have a great day.